So, Brother Will, hopefully you're able to see this in terms of my screen. I'm just getting up. I had some fried rice last night. Incredible. I usually make like a curry and fried rice, and I was using Chef Wangang's technique, which is a whole different. It's called egg floss, and the technique of making that kind of fried rice is pretty extensive because I make fried rice around the clock, and man, did that stuff come out so good. I mean, you could tell when you get up in the morning and you're still like heavy, you're just feeling like so today working out is going to be a challenge because I had eaten so much last night. I didn't mean to eat that much, but my goodness, was it good. Incredible. But anyways, yeah, let's get into this. A lot of times folks do the 0 day, the SPX. And again, it's like, it's about selling the first thing I look for is selling volatility. Okay, SPX is down about 35 right now. And again, it's been on a tear, and I'm gonna use SPX, but you could also use the XSP. This thing has just been, the largest rally it's had since January. So, there's a chance it could pull back. Not saying it will, but there's a good chance that it could pull back, maybe come down, maybe 30, 30 more points or whatnot. This again, with this administration that's in office, anything's possible. So, hey man, how you doing? Yeah, hold on for one sec. Yeah, yeah, yeah. The YouTube was playing. I'm doing the live stream as we're talking. Yeah. Yeah, yeah. Okay, wonderful. hmm So we have S&P down, volatility. Again, I like to see where the volatility is, slash VX, and volatility. It's up a little bit. It's 19. Okay. I could see it in slowly wanting to, slowly wanting to make itself known because volatility's just been getting whacked, for the last several weeks. So if you got volatility up, S&P down, that means you have a little premium you can sell. That's basically what it is. You have that premium that's and so a lot of the times it's the same thing. A lot of folks are doing like iron condors and iron butterflies using the SPX. It's pretty expensive. Okay. And if we're gonna do this with 0 day, of course, July 11th, that's today. And it's the same thing as what I was doing with strangles, iron condors, and what I've been doing is double butterflies. Now I'm getting hurt because I did a double butterfly. It wasn't necessarily a 0 day. It was a few weeks out. So I'm getting beat up on that one. But the concept doesn't change. I was doing 0 day with these double butterflies. With butterflies in general, I was doing 0 day, and that's because I was basically when you're doing 0 day, the theta, i.e., the time, everything is compressed, so you would be in and out within a couple hours. It's more like a scalp. With 0 day, clearly, you're in and out because of the fact that you don't have that time. AKW, good to see you. Yeah, yeah, triple Qs. Yeah, yeah, KW. Triple Qs were definitely through the roof. Everything has been just on a tear. And I can understand it. It's you've got dollar down, which dollar was getting completely destroyed. And the thing is, KW, with their dollar being completely destroyed as it is, it makes buying equities, you have you have enough that you can borrow and leverage because you're able to, you're able to get a lot of those dollars for cheap, and that's something that, and then you have gold, which has been, going through the roof. But now today, dollar is up just a slight, I think dollar was up earlier, just earlier, a few hours ago, just barely. So yeah, I can understand that, KW. Yeah, the triple Qs were on a tear. They were just literally, nonstop, basically all indexes, because of the fact that, it's climbing the wall of worry. Everything is climbing the wall of worry right now. I mean, just keeping everybody wondering, when is this thing going to pull back? And what I've been doing is, I'm a contrarian, so I'm getting hurt on one of my butterfly trades. But the thing is, KW, what I've been doing is trying to play that contrarian by doing like calendars. I've been doing triple Q calendars. I had one up, a triple Q calendar that I've been really wanting to get into, but I just can't. It's just couldn't get filled, and it would have been great. It has room to the upside, but it has more. Profit to the downside. Hey, brother Will, good to see you. Yeah. So Hotep. So basically, I've been doing that, KW, just for, just making sure that I could, because I'm a contrarian by nature. I mean, that's just the nature of the game. Most traders are. But just by looking at where everything's at, most 0 days, people do the SPX or the XSP. I was trying the NDX for 0 day for NASDAQ, but I'd tell folks, no, I can't. No, the liquidity for me is not there. And the price and liquidity is just, I won't say it's a losing, project, but it's just something that I'm just kind of like, I'd rather, if I'm gonna do an index, I'll try to find out. And I don't do things that you'll get assigned, like SPY. I did that once, it worked out, but that's just too risky, because you got assignment risk with things. You need something that's a cash index. Anything that's a cash index or futures. But it's best cash index. And I was doing 0 days when I was and this is funny because I was doing these 0 days in the SPX before 0 days were out. But what I was doing was like 2 days out and whatnot. And I was doing a lot of butterflies. The reason I do butterflies is they're very directional. And markets, and because the gamma risk is so intense that in terms, it's 0 days. So you're going to get a market that moves. Rarely on 0 days do you get markets that will stay within that range, especially now that Donald Trump's in office. So you're going to be highly directional with this type of strategy. With the 0 day strategy. So what I've been doing is, I've been kind of like, going back. Yeah, S&P is taking a little bit on the hit. They're taking a little bit of a hit. Because here you have if we were to do this, because volatility is up today, it's not, the IB rank is still low. It's only 8. You want an IB rank that's like 30, 35. So clearly the volatility is not matching because if we go back to the VX volatility, because remember, everything's about selling volatility. Volatility is up like 30 cents, but you got a market that's falling like crazy. The thing is even if a market it's not terrible, it's definitely falling. If you look at the SPX today, it's taking it on the chin a little bit. It's not like, oh my God, the world's going to end. And let's go down to like a 5-minute chart. And so you could see that today's market is definitely taking it on the chin. Look at that. Okay. It's, it gapped down lower. And so, this thing could easily get down to around maybe 62, where are we at there? What is that? I cannot see it. Let me expand this so I could see if I could see it. This thing could easily get down to, say, 62.30, which is only 8 more ticks before it starts to go back up, thus filling this gap down here and going back up, because I can understand that. I'm not saying, well, it already had filled that gap earlier, but it could easily get there before bouncing back up. And usually on Friday, they like to bounce it back up anyways. Administrations, doesn't matter whose it is, they always like to have a winning Friday. A lot of times traders don't want to be long over the weekend. They don't like to hold, things over the weekend. So, it's a crapshoot. It is what it is. But the bottom line, the main bottom line is you just want to be in and out within a couple of hours, or what I've been doing, because it's a crapshoot. It's basically a gamble. But what I've been doing is trying to put the edge in my favor by doing double butterflies and doing trades that are around the expected move. Okay, around more than, and especially what the ones that have really been helping is I've been going out to the second standard deviation, because of the fact that you got a Trump administration that is literally, I call it the black swan administration. I was almost said the gamma, the sigma that has been happening under Trump. It's been going to sigma, easily on a Friday. I mean, things have just been out of whack. One sigma, your first standard deviation, but things I've gone and put butterflies out to the second sigma, because anything can happen. And here's what I do when I put these butterflies on, very cheap butterflies on XSP and whatnot. What I do is I want to cover the cost of commissions. That's the main thing. So if I do a butterfly, I want to make sure, because it's going to cost you $4 to do a butterfly. So what I do is I'll do a butterfly that has a credit of $8. So that way, at least my commissions are taken care of. My commissions and fees are taken care of should this thing expire and I make money or whatever. And the good thing about Tastyworks, I don't know if you have Tastyworks yet, Brother Will. I've been harping on that for the last year. The thing is you pay nothing to get out, whereas other brokers you have to pay to get out. So so that cuts the possibility of commissions in half. Markets are bouncing back right now as I'm talking to you. It's already bounced back 10. So if you could see, you can see it on the chart. It's already bounced back 10. So, the thing is it's already starting to do what I was thinking that it could get down about 8 more points before bouncing back, but it's bouncing back already, so it doesn't matter. So anyways, double butterflies. Again, everything's about selling premium. Okay, and that's the main thing to keep in mind. With the SPX with a IV rank of 8, you're not going to really be able to get a lot of premium on this. Okay, because there's barely any, especially now that markets are bouncing back. There's barely any premium in this particular trade. But when you're doing 0 days, you're more directional than anything else. Okay, I mean, because the market's going to move everywhere. Okay, that it's 0 day. Gamma risk is high. So, anyways, if I do double butterflies or even a single butterfly, a lot of times when they do 0 day, if they do a butterfly at the money, they'll do like an iron butterfly or something and try to capture the premium. So, what I'll do is I'll see where's the risk. Where can I capture more premium? The calls or the puts? Well, you can go through, you can use your implied volatility to find that. Okay, you can find your implied volatility and see, okay, at the money, you got 18% here, and then you've got, well, it's basically the same. There's no real, if you're doing the at the money, there's no real advantage. 1834. So, I mean, you could, and we'll get into the skew situation later. So, anyways, you'll do 2 of these, and then you could go out to your first standard deviation, okay, which is that. And let me get this and put this at 1. Your first standard deviation down there, and your first standard deviation up here, and then you got your butterfly. Okay, that the chances are. Thing is this one. Wait a minute. I'm sorry. I was going to make it an iron butterfly. Let me just. I have this instead of that. Let me make this an iron butterfly. That's what I meant. So you sell the call, sell the put. Okay, so you have this. Okay, because I'm just okay. You got you selling the call to sell the put. You got the put, first standard deviation, call, just over the first standard deviation. You're getting like $15 of credit. The trade costs you about $9. But the thing is you're not going to go and try to get that $15. Remember, this thing moves. Okay, you've got 20 on each side. 20. You've got 20 points to the upside, 20 points, a little about 25 points to the downside, which is understandable because the velocity is more than likely going to happen. So this thing, you've only got like 20 points. So you want to be in and out of this thing. You, at very most, you'll only make like 5 to 10%, maybe 8% of this. Okay. So it's, so you'll probably make about $70, or yeah, about 70, $80 on this within the next hour or two, because you're getting this credit. You have a $900, which is, you're getting less than 10% of your buying power. But again, it is a a scalp, for lack of a better term. You can do that, and that's the SPX. Now, a lot of times folks will go, if you want to go to that second standard deviation, you will get more credit. Okay, without a doubt, you will get more credit. Problem being, though, with that second standard deviation is, you're going out, say you're going out, and this I think would be more of a, because that's 50, 90, that's 40 points to that side. And then you've got 50, 10, 40 points. So this is equal. The thing is, you do get more credit. Your buying power goes up just by a little bit. Okay, or it doubles your buying power. You more than likely get out of this under $100. Under, let's see, about 10%, so a little under $200 is what because you're getting $20 worth of credit. Okay, and so the thing is you want that market to stay in between, and we'll look at the graph of that. You want that market to stay in between here. Okay, let's do this so you could actually see this. You want it to stay in between there for the next couple of hours, because basically, you want to be in and out of this, and you get your 5 to 10%, whatever it is, and get out, because this thing is gonna, the buying power, it's about $2,000 is what your buying power is. Their ultimate loss of everything you could lose is $2,000. Okay, and so the thing is you will be getting this credit, this $2,000 of credit basically. But the thing is you're not in there to go ahead and stay the whole day. It's definitely not. But that's what a lot of folks do. Now, this is a big contract because it is the SPX. So if you do it in the XSP, just take everything and divide it by 10. So it'd be a $200 trade, and you would try to get 20 bucks out of the trade per contract. So that's the thing that, and that's just with iron butterflies. Now, if you ever watch the Tasty, they do a lot of 0-day stuff. They did a lot of research on the 0-day. And the thing is you could do like either, that's a butterfly. If you want to widen your strikes and do something kind of like it, but want to pay a little less money and have a better chance of this working out for you, then you could do the iron condor. But what I do with iron condors is I may do kind of like a butterfly, going from the 50, you got 50 and 30. So we'll say 40, okay, would be the first one. And you've got 50 and with that first standard deviation, okay, since we're starting to pull back. So the risk is definitely going back up to the upside. So we'd say 50, we'll go 1, 2 strikes out. Our second standard deviation is already 2 strikes out on this side. So markets are definitely, climbing back up to the upside. So we'll say, so what I would do is, instead of a iron butterfly, you could expand this out a little bit and then put your other strike, of course, outside of your second standard deviation. And then you've just expanded that, giving yourself a little bit more, even though the probability of profit is very low, because of the fact that if you stay in this the entire day, and this is at the close, basically, of course you're not going to be chances of getting that is very, very, very small. It's going to cost you about $1,100 buying power. You get $8 or $800 of credit on that. Okay, so the thing is basically it's a little bit less risk, But again, it's the same thing. It has to stay in between that. And again, in the next few hours, or the next couple of hours. Again, this is just in and out. This is not something you're going to stay the entire day. Okay. You could see that if it starts to move against you, you're going to be down, say the theoretical price. If this moves against you, theoretical price, you'd be down like $100 if it goes outside of that in the course of the next couple of hours. You'd be down, possibly theoretically, you'd be down, say about, to the upside about a couple $100 if it goes to the upside. So the thing is, if you want, you could scalp this to get more, as this thing moves. What you would do is, if it starts to move against you, you can go ahead and, I like the term buy the guts, sell the wings is what they talk about. You'll just recenter this, take whatever profit you can and recenter it, and just keep recentering, which means you're just moving this thing around. Again, that is something that, that I definitely, you're just scalping basically, making a bunch of trades to scalp it. This is, again, it doesn't matter whether the market goes up or down, as long as it stays within a certain range for the next couple of hours, you get your 10% and you leave. Okay. You get your 10%, which would probably be about $90 and get out. You could try to go for the 10% of the buying power, which is about $113 and get out. Okay. Again, it's, you're working because of gamma. You're working with something that can move everywhere. As you saw, the market opened up, it was down 40. Now it's back. Okay. And it's only down 26. So that's, so this thing does move. It's going to move on you. But so what I've been doing is the lotto ticket trades. And the lotto ticket trades I was using before, I was using the expected move off of Thinkorswim. But, since the markets are at all-time highs, there's no real gauge as to where the expected move to the upside in terms of an aggregate of expected moves, because I was using the aggregate of the last times expected moves have been breached. And I said, chances are to revisit that. Well, there has been no breach to the upside with expected move. There has been none. Why? Because markets are at all-time highs. They've been, everything's just been going up. So it's kind of hard to use that gauge to say that, okay, we're going to use the aggregate of expected moves to determine where the market could go to the upside, when there's no aggregate, there's no gauge to what that aggregate could be to the upside. So, I've been, so what I do is I've been saying, okay, since chances are Donald Trump will move this thing everywhere. I mean, this administration has been moving markets more than anything else. Okay, with whatever tweets, with whatever, tariffs, it doesn't matter. This thing does move. And so my thing is like, I just want to get it, it's like you're trying to, if you're trying to hit the target and say it's got to hit this target on the downside and the market goes up, well, if it doesn't hit that target on the downside and the market goes away from you, at least my commissions are covered. If I say I want to hit this market to the upside and it doesn't hit to the upside and it goes to the downside, well, at least my commissions are covered. So what I did is I said, well, I'm going to put two targets in there. And I'm going to put two targets into the highest probability where this thing could go. And I usually wait toward the middle end of the day. And then I'll put these trades on. And what I do, we'll use SX or XSP for this, which is it's 10%, because this could be, again, you use the SPX, you're gonna spend some money because it's a big contract. So we'll go 0 day, which is today, XSP. And what I've been doing, here's your standard deviations. Now remember, however this thing is, like, it's down $2 right now. So that means it's down 27 in the SPX, because remember, you multiply by 10. And what I've been doing is I've been saying, okay, toward the middle of the day, because that's when you start really seeing this market move, I'll go down to the first standard deviation and I'll put on these butterflies. And what I'll do, they're called broken wing butterflies. The first one I'll put on, and you can't put multi-legs on here like you could do Thinkorswim. So you have to put the trade on, and then you come back and put the trade on again. Now, what it is, you could do this like during the day, but the thing is because it's butterflies, you make your money as time passes, which means you're going to make more of your money at the end of the day, when these are directional, that's where you want the market to go at the end of the day. When they're non-directional, like the one I just showed you, you don't want to stay in the end of the day. You just want to grab that profit and get out. Okay. And then the SPX is better for that because you're going to make more money. You know, like if I did this with this, I don't only be looking at like, if I, instead of, it'll be a $200 trade, but instead of making $200 or whatnot, I'd only be making $20, to stay in this trade. The 10% of whatever it costs, I'd only be making like, $20 and in the next 2 hours on this particular type of trade. And with the cost of commissions, you're only, you literally you'd be making $15-20. So when I use XSP, I'm looking at going in directional than I am non-directional. Whereas if I did SPX, the big contract, I would be going non-directional because I want to make use of that premium. I want to make that money with that premium and get out. Okay. And so I'd be looking at markets and saying, okay, just stay there. Don't move too much. And just it's like ice cream. Let it melt away. Let the premium melt away and you keep it and then get out. Whereas the other one, it would be more like, I don't care about the premium as much as it's a directional play. So my thing is like, just don't move until the end of the day and then move like crazy wherever you want to go. But hopefully it'll hit your target. And if it hits your target, you're doing like a 10-to-1 trade sometimes. Sometimes, it could be like a 5-to-1 trade, which is great. And that's what happened to me a couple weeks back, about maybe 4 weeks back. And again, the probability of profit on those are not super stellar. Now, the thing is your deltas are going to move this thing everywhere. Okay. And what I've been doing is I've been going out to the first standard deviation. Right now, this delta, where are deltas at on this? So I've been going in with the first standard deviation toward the end of the day. Okay, so we're looking at, it's a high delta. Which means chances are the market is, the higher the delta, the more the probability the market's going to get there. But what I've been doing is I go out and I do broken wing butterflies, 2-to-1 butterflies, which means you sell 2 of these around the first standard deviation. Okay. And, wait a minute. You know what? Because usually this thing will move. So I've been doing this around the second standard deviation because of Donald Trump. Toward the end of the day, this thing moves more than anything. And this is why I wait. First standard deviation's here. Second standard deviation is the second line. So as this market moves all around during the day, and it will move. It'll go buck wild. This one, again, you're not looking to get premium, to get that premium, as you would, with the non-directional. You're getting premium with that. This one, you're getting just a little less. Now, here's the kicker. Right now, this thing is telling me, let me just double check. Yeah, it's telling me that it's going to cost me a debit. I don't do this for a debit. Okay. That's why I said that I try to wait toward, the middle end of the day. Every time I do this, I get a credit. And right now, you're not getting that credit. So this would not be the kind of play that I would do. Wait a minute. You know why? I'm going to show you why. I had this wrong. I'm on the call side. I meant to put that on the put side. Let's get back on the call side. This is why I wasn't getting the credit. Let's go to the second standard deviation. My bad. I was on the wrong side of it. Okay, let me get rid of that. That's why it was a debit. You always do this for a credit. Okay, second standard deviation. We do that. Okay, yeah, my bad. So we'll do 2 of these on the 2. So now here we're not getting any credits on that because, of course, there is no premium there for us to get. Normally, I like to get 10%. Again, like I said, 10% of whatever my buying power is, which is going to be 98. I like to get 10% of that. Well, we're not getting, because that's it's a dollar debit. So we're not getting any credit there. You can get, and again, like I said, I do this later in the day. Normally you'll get like 8 or 9, anything over $7 of credit, because that takes care of your commissions. Okay, that means it's you're not going to be paying for this trade. Okay, and that's what I always look forward to. If I'm not getting $7 8 worth of credit, I'm not going to do this trade. So if I do both sides, that means that I have literally, the cost of the trade is free, but it's not a free trade, because if it goes past your strike, like it's happened to me before, when it's gone past the strike, and especially toward the end of the day, it could cost you. Okay, you're going to get hurt. Now, here's the thing: I always make sure that my max profit is greater than my max loss. Right here, I wouldn't do this trade. My max profit, I usually like my max profit to be $20. So if it's around the $100 range, I want my max profit to be around the 80. I mean, my max loss to be around the 80-ish dollar range. And that's why I couldn't do this trade right now. Then later in the day, this thing will change on you. Okay. This will definitely change on you. If you see that now, again, we're getting more debit, and you're seeing how the max profit and the max loss are changing on you. I've always been moving this around just to make sure that I get the credit, because to me, it's a credit trade. Okay. Here we're only getting $1 credit. We're out. What we're doing is we're centering this around the second standard deviation. Okay. And again, and I usually, like I say, I wait till middle of the day, and then I start looking to see where because the markets really start moving crazy, especially on a Friday toward the end of the day. If you see this, markets are actually recovered. It's only down 264 right now. So it went from 44 early in the morning, all up to craziness. Now it's down to 2. So therefore, it's recovering, which meant that if you did that scalp, you would have probably made about a good, maybe not really $100, probably about $80, in the first, when we first put this thing on. Okay, you could, you would have probably made about $80 since we first put this on. That's why I said it's more of a scalping situation. You get in, you get out. But with this, even though it's a 0 day, it's not necessarily as a scalp. It's more like you're putting 2 targets in and saying, I don't care if you go up or I don't care if you go down. I just want those targets to be hit. And if they're not hit, if it doesn't go too far past the targets, then you keep the commissions and you keep the credit, and you made $4. But if it goes past the target, that's when you start having to manage. Okay, that's when you start saying, okay, I'm gonna either move one of the butterflies closer to the market and try to get more credit, so that way I'm not getting too hurt, or I'll just take the trade off. Take the trade off and get out, so I don't lose the entire thing. To lose the entire buying power of $100. So the thing is, and usually I get out if it goes like 2 or 3 strikes past my standard deviation. And again, I've seen that happen many a time. That's if it goes like 2 or 3 strikes past that second standard deviation. If I am down over 50%, I'm gone. That's just a lost trade. But if I'm not down over 50%, then I can stay in just a little bit longer, and usually it'll snap back. Okay, because remember, second standard deviation is saying it's a 93% chance that market's going to hit that target. Okay, it's not going to go past that target. If it does, and I'm 50% down, I take the loss and I keep going. But if it's not down there, and that could be because of the price of the trade or whatever, that means the chances are it's going to snap in there, because even though I've been in that problem where it's definitely gone against me. And that's what I call the Trump trade. What it is it's just the craziness with this administration that's in office. Things are everywhere. Okay. But the good thing about it is when you're out at that second sigma toward the end of the day, chances are that thing is going to end up hitting your target. So, so I centered this around the second standard deviation to the upside. Right now, it's only $1 credit. So I could not take this trade. This would not be the kind of trade I would take. Because, and it's just a regular broken wing. But as you see the day go by, this one is just outside of the second standard deviation, and you're paying a debit. So chances are this would probably be where your starting point is on the upside target, because it's telling you this thing has they're saying this thing is going to move around $2. This is what they're saying. It's 181. I always round it up. And because of what's been happening, I've always doubled that. So I'm saying that this market can move $3.60, which means that would be from 625. So we'll say 629 is where this thing can go. Well, this is well outside of the 629. 629 is right there. So I'm saying that this market, doubling this number, adding it onto the price, I'm saying this thing could easily go to 629. Well, 629 is your first standard deviation. Again, this is just now. As the market goes, you're going to see this thing change, and it's not going to be 179 anymore. This thing's going to change like crazy, especially toward the end of the day, and especially because it's Friday and because it's Donald Trump. That thing could easily go to $3 or $4. So the thing is I always double that and put my strikes accordingly, as long as my strikes give me $8 of credit. I've never really gone underneath $7. Why? Because that covers all commissions and everything else. So I just put it on my credit, and you could see it when you put it on. You'll see the cost of the trade. It'll give you a credit, and you don't see your buying power go down. I mean, you don't see your the cost of that trade won't go down. It'll say, look, the cost of this trade, you're getting $4 of credit with commissions and fees and everything else. You'll see this thing say $4, which means that you're getting $4 whether you win or lose. And so that's what I've been doing quite a bit for the 0-day XSP trades, where I want this market to hit a target, and I'm not just looking to try to take premium out of the market. And that's what a lot of like the Tasty guys are in for the first technique, which is getting premium out of the market, staying in. And again, I would never use NDX or any of these others, RUT or any of these other indexes, because of the fact the price and the liquidity and the volatility for me are not worth it. That you're going to lose. Okay, I mean, you might get lucky a couple of times, but you're going to get hit that third time with a sledgehammer. The SPX is the liquid. It is the liquid security for this type of, and it's 0 day. So, that's just what I've been doing. So here we have on the upside, once we start seeing later in the day, this thing will move. We'll see that credit increase like crazy. And then I'll be centering this. Right now, it's centered around the second standard deviation. Okay. Again, this is not necessarily a volatility play, or a time theta play. This is pure directional. I do this for direction. I don't care about theta or anything else. Whereas the other one is more volatility, where you're capturing the premium. So again, 629 is way down here, which is saying, as of now, chances are this is going to be the point where this thing will more than likely go. But I have this centered around the second standard deviation, which means that as of now, it's a 93% chance that market is not going to get there. Okay, that there's that it's not going to go over that point, that center of my triangle. That there's a 93% chance or 95% chance it's not going to get there. So so that means I could keep that little $4. If when this thing changes, that means that I could keep that. If it goes over that, and here's the other kicker. Right now, you've got max profit is just a little bit underneath. A little bit over the max loss. I want that ratio to be a lot higher. I've gone as high as 89 to 111, which means my max profit is 111. My max loss is 89. I've gotten it that, that's where I like to, keep it, because that's usually what I notice in the SXP. And then I just sit and wait. And whatever, and then I just wait till the market does. And the good thing is, if it goes and hits your target, or even if it goes over, it doesn't matter. These are cash indexes. They expire, you don't get a sign, and you just keep it moving. But I usually manage it before it hits that, like if it goes a couple bucks, if it goes toward my short strike toward the end of the day, or it goes over my short strike, and it's between my short strike here and my long strike toward the end of the day, I start to tell myself, look, I got to get out of this. I got to get out of this trade. I'm 50% down. I'm out. Let me lose my $40 and keep it going. But since chances are this thing, again, I'm at that second standard deviation. It's very rare, unless Trump gets on the mic and starts acting a fool, then you're going to start seeing this thing go against you. But usually I just do that. And then I do the same thing to the downside. So I have two targets that are on each side standard deviation. We'll do the same thing on the downside. So I put this trade on first toward the end of the day. And then I go and I put this other trade in, same thing, going down toward the end of the day, center around the second standard deviation toward the end of the day. And so you have a double butterfly, or double broken wing. It's a skip strike butterfly, basically. That's all it is. You've got this right here, this credit spread, and then you got this a debit spread, and then you got an embedded credit spread down here. You skip one strike, and then you put the your defined risk down there. That's all this is. Okay, here you got your max loss, and so this one is not happening because of the fact that you've got again you're losing more than you're making. I always make sure that I make more than I lose on this right here. You okay, now you would start. This is a little bit over the second standard deviation, so which is good, which gives you more room. But again, you're not making any credit, so I wouldn't put this on just yet, even because it's only $1 credit. It's still going to cost you to do this trade. I'd always make sure I have at least $7. Okay, I have to have that and that's per side, because that way the cost of the trade is taken care of. Okay, commissions, fees, everything is taken care of, and all you got to do is just sit and wait, and you're not paying, because commissions will eat you up. That's what eats you up. That's why these brokers are always telling you trade more, trade small, trade often, or whatever, because they make money on commissions and fees. And of course, they want you to trade a lot, and which is of course, the more you trade, the more the occurrences work in your favor, and you can actually get a good statistical output of what your methodology is going to be. But for me, my thing is like, yeah, I like to trade small and often, but I'm not going to do that just to do it. I want to make sure that the probabilities are totally in my favor. Probability of profit right here of making at least a penny or more is 90%, 99%, which means it's a credit trade. So the chances are you're going to make that money. We don't have the P50 up because, again, it's less than $1 right there. But when you start getting, when you start seeing the increase, you're going to see this max profit go up to like 110, 111, and this will go down to about 89, 88, if that. You're going to start seeing that go down, the max loss go down. That's when you want this trade on. And then the same thing goes with this. It's a directional trade. It's not about, trying to use theta or whatever. You just want this market to go right in the center here or stay above it. If it starts going down, you're at 117. Once you get to about 116 or 616, 616, maybe maybe around this. And again, this will move. So these numbers aren't absolute, because this market's going to move all day today. You'll see it more than likely. It's Friday, Trump, everything else. Chances are this thing will move. So what you want is you want to make sure that in between this, like this is your break even. If it starts going down and out of your break even, and this is your long strike, down here, you don't want it to go past your long strike. So, and that's toward the end of the day. Let's get that long strike out there. Okay, which is way down here. Once you start seeing this thing go down there, I wonder, wait, you know what? Let me see if I expanded this right. Because for some reason, I cannot see the bottom. It's hard for me to see anything today. I was working on my Braille all morning because I got Braille class later. Once it starts going down here, you're at 615. You're in your theoretical, chances are you're going to be down around 50% because you're too, And so the thing is if it's doing that and I've only got like an hour left, I take the trade off, even though it might snap back and you'll make that profit. It's like if it's down here, chances are that you're gonna it's a 50-50 shot that you're gonna you're playing serious risk. And that's like if you got like an hour or 40 minutes left, it's a nail biter. And I've had a lot of nail biting days. But if you see this thing start, and I've seen it happen many a time where this thing would just shoot to one side or the other, and then all of a sudden it's like, okay, I'm out, and then it snaps right back and goes right to that 93 percent. What it is that standard deviation is telling you as of now, if this market continues the way as it is, that percentage that is going to get there is 93%. That thing will change. That delta will change as this market is going buck wild. But at least I set it up to where, okay, the higher probability is, even though it moves like crazy, there's a real high probability that you're either going to get that credit that you originally had, or you're going to get, close to it. You're going to be able to make close to this profit and you won't get the entire profit a lot of times. You probably get like 50% of that. But the thing is that's, still yet you have a high probability of that happening. Okay. Of that thing snapping into that area. And that's all you care about is the probabilities. So that's what I've been doing there, Brother Will, for a lot of the 0 day. You could, again, you got two different 0 days. You got the 0 day where you could get the premium, which is iron butterflies, iron condors, stuff like that. Or you could do the 0 day where you're looking for targets, where you would use the XSP for looking, for direction. When it comes to like iron butterflies and iron condors and XSP, I can't see any kind of profit potential in that because you're not getting enough credit. It's just really, I mean, if you were to do this and you set up, the 0 day for an iron condor or whatever, iron butterfly, and butterflies, you get more than, of course, condors. So say you did your iron butterfly, okay? And you put that on your, you could use your first or second standard deviation, and that is, okay, that's so if I did first standard deviation here, there's a lot more room to the downside than the upside. So this is definitely a skewed iron butterfly. Remember, the first standard deviation it's saying within, by the end of the day, there's a 68% chance that this thing will be between 629 and 622. The thing is if you could use the standard deviation for this, but like I said, since this thing has got a high gamma risk because of the fact it's it's a 0 day, you do this equal width. So this is 622, so that would be $5 down there, and 632, $5 up to this side. Okay, you're getting $1.88 credit. This thing will cost you $3.22. So your buying power. So at most you only get $18. Okay, if that, $19, maybe $20 that you could get on this trade if you stay in this for the next couple of hours. Stay in it until you get $20 and get out. It's going to cost you $300 to try to get that. Okay, it is, you're getting half the profit of what it's going to cost you because it's a 2-to-1 type of trade. So the thing is, you could be that risky, because it's like an iron condor. You're trying to get that. You're trying to get that credit, but getting $18 worth of credit in the next couple of hours for me is not necessary. And especially you got a market that's already moving up. It started out down 44 points. Now it's only down 18. Okay, so the market turned around. Like I said, it could have gotten down to that 618 or whatever it was, but it didn't want to get there. And chances are, you're seeing it already. Market's recovering on that gap. So, 627 is refilling that gap. And, of course, you got an administration that is manipulating markets, whatever. Chances are you're just going to go ahead and try to ride it out. Volatility is definitely going back down. If you see what happened to volatility, there is no premium to be sold to get, you're not making that money on the premium. If you see the volatility, let me see if volatility will come up. Yeah. See, volatility spiked up this morning. Now it's coming back down. So, and it's back down to where it started early before the market went down. So, I mean, it's a 0 day trade. Like I said, you're looking for, this is XSP. You're looking to try to get premium if you're going to do the iron condors or whatever. That's a premium getting trade. The directional trade is one that I've been doing quite a bit, just because, the craziness of this administration and everything else. My thing is like, hey, I just want a target to get hit. And if I were to do this as an iron condor, oops, wait a minute. If I did this as an iron condor, let me get back to where I was at. Okay, we got that. Okay, I would do like I did last time, or like I showed you on the other one. Go 2 strikes out instead of making it a butterfly trade. You get less credit, cost you a little less, but at least you have a better chance of getting getting higher profit, a better chance of making money. Right here, you only had basically, it was like a 50% chance of making money. It's a crapshoot. So if you expanded these a little bit, say 3 strikes out here, 3 strikes out here, then you've got a 70% chance of making, you're only getting 23 on your credit. So this is one of those trades where, you would have to stay in the entire day. You would have to stay in quite a bit. The more and more you move those strikes out, the longer you have to stay in. And I don't like staying in on a trade like this. I would rather do the double butterfly, because it costs less in terms of commissions. And, so if I did this, I'd only be getting 68 cents of credit. Of course, it would cost me, I'm that 300. So it's getting more to where the iron butterfly it's a 50-50 crapshoot, but at least you get more credit that you can take home with you. Where, and that's the XSP. The SPX, of course, and here you're getting that 183. It's just that, you don't have to stay as long. You get your credit, you're $15 and get out. It's not, or you're $18 and get out. So it's like, again, if you're using the SPX, that's $180. Okay, but it's going to cost you, the buying power is going to cost you a lot more. You're looking at $3,000. Okay, for buying power. But the thing is it's worth it, because you're making at least $1 or more on your trade and not making 18 cents. You're making, you're getting that credit, because remember, you're only staying in this for 10%. And 10% of 186 is 18, is $18. And that, $18.60. And to get that, you'd be scalping all day just to try to make a buck. So that's what I've been doing there, Brother Will, just for the 0 day. But if you're doing the smaller contract, directional, you're doing the larger contract, go for non-directional. The larger contract being SPX, smaller contract being XSP. Now, I've been doing on the Qs, I've been doing a lot of calendars and diagonals. But I was doing 0 day on that. I'm doing like a week out, and I'll do another video on that. Why? Because they're at all-time highs. Anything that has all-time highs has damn near no volatility. If you see the volatility, like what was it on the SPX? 8. Now it's XSP is 10. Again, there's no premium. There's no credit. When volatility is down like that, there's no credit. And we went over that on the other ones that I had about the volatility. Look at where the Qs are only at 10, IV rank of only 10. And then you've got volatility that's down like 14, 11. There's nothing to sell there. So what I've been doing is even though, I should say there is something to sell, but I have to sell something that I could make more money when I sell it than when I buy it. And that's when I've been doing calendars and double diagonals, double calendars. I've been doing that. And the thing is, should Qs, since they're all-time highs, these are things that you want volatility to go up. So if I'm doing stuff in low volatility and the Qs fall, that means volatility will be going up. That means that you have a greater chance of making money because your volatility is in your favor. And the Qs, I've been using that specifically for calendar trades, because I'm not getting enough money on it's just too costly on SPX. I've been doing it on SPY, but I don't get enough strikes. The granularity of the strikes weren't allowing me to do it the way that I wanted. I want the granularity to be where I could do like 7 days out on dollar granularity and 14 days out on dollar granularity. But with this the SPY, it's only $5 granularity between strikes, like 11 days to 14 days out. And that's not enough for me to do this kind of, I wasn't able to find the strikes to be able to do this particular calendar. Whereas on the Qs, I was able to find it. The granularity was great for that. And so I was trying to put that trade on for the last week, but there was no buyers. Nobody would sell it to me. Nobody would sell the trade. And so I was like, okay, it is what it is. It's a great trade because it would have been profitable today. And made a great profit. Let me see. We'll check it, because I want to see, because it never got filled. And let's go to orders in the Qs. That trade never got filled, and I really wanted that. It was a similar order. Yeah. So so I would have been up 10 cents. Okay, $10 on this trade. And I was getting in, I would have been up $10, and I tried to put the trade on a couple days ago. And I tried to put it on, and actually I tried to put it on. Let me see, because even before that, that was 78. Let me see, even before that, I tried to get in, what was it? Yeah, so 78. Okay, so it was at 78 was what I tried to put it in, and now it's like $10 more. So I would have made $10 on this as of now. But I was going to stay in the trade for per contract. I was going to stay in the trade. Let's see, for like 3 days, because you had a great theta. It's like $10 a day on theta, and that's per contract. So what would have cost me? I would have made my 10%, a little over 10%. I could make that by Monday, because it was really I'd be out of that trade by Monday, and that's what this whole thing. I think was it a Monday trade? Yeah, no Monday, no, about Wednesday, and I'm making $10 a day. So all things being good, and I had more room to the upside. All things being good, you could make your 20% by Monday. I mean by Wednesday of next week easily gotten that. And that's the trade that I was trying to get in, especially now that this thing is not, because when I got in, it was only like $7 a day in theta. Now it's like $9, and that theta only increases. You make more per day as long as that market doesn't go out of your strikes. And this was a double calendar, and that's why I like the granularity of the cues on that particular style of trade. But we'll do a whole different video on that later on. But anyways, that just gives you kind of an idea, of what I do 0 day and whatnot. That's just, that's something I just been working with, just for myself. Just, I kind of dig it. So anyways, you guys take care. Hotep.